Hello everyone. I would like to thank you for joining us today. My name is Sarah Landrum and I would like to welcome you to the 5 Factors That Affect Your Credit Score webinar. In April we offered a webinar that was titled How to Read and Understand Your Credit Report, and if any of you out there was on that webinar, you may remember that we had said over the next couple of months we would be offering some different credit topics. So today is going to be the second in that series, and the information is going to be actually a joint effort that's going to be brought by the Credit Unions Care Foundation of Virginia and DCCU. The Credit Unions Care Foundation of Virginia was formed in 2009, and their main purpose is to help credit unions in Virginia continue their social mission. So in 2015, the foundation launched the Smart Credit Check campaign to help consumers understand the importance of checking their credit report and understanding their credit scores. So today we are going to learn during the webinar about payment history. We're going to talk about amounts owed to creditors, length of credit history, new credit, and then credit mix, all of these things that can affect your credit score. Just a few housekeeping items. Your lines have been muted. You will have the opportunity to ask questions at the end, so if something comes up throughout the webinar, you want to ask a question, just jot that down and we'll hopefully be able to answer that at the end of the session. And before we actually get into the information today, I'd like to give you a poll question. And this question may be familiar to you all. I had sent a survey out about knowledge and credit scores a little bit earlier, and hopefully you had the opportunity to take the survey. And if you didn't, I do highly recommend that you do it after the webinar, and please take this information and pass it on to others so they can learn about credit scores as well. So the question is, which of the following actions helps a consumer raise a low score or maintain a high one? A, make all loan payments on time. B, keep credit card balances under 25% of their credit limit. Avoid opening several credit card accounts at the same time. D, all of these above. Or E, none of these. I'll just give you a few seconds to make your choice. And if you said D, you are correct, all of these. And we will be talking about A, B, and C as we go through the information today. And like I said, in April, we did have a webinar about credit reports, how to read them, how to understand them. So one of the things today that I want to talk to you about is not to confuse your credit report with your credit score. Even though they work with each other, they are two totally separate items. A credit report is a report that is generated by the 3 credit reporting agencies, TransUnion, Equifax, and Experian, and they can be sold to lenders or maybe other businesses that want to offer you services, and we'll talk about them today as well. But these reports are sold to them in order for them to know whether or not they're going to give you a loan or offer you services with their business. And it basically just tells the history of how well you have maintained your credit. But with a credit score, it's a number which predicts credit risk, and it shows how likely you are to repay a loan. So when you decide that you want to maybe apply for a vehicle loan or you want to apply for a mortgage loan, you're going to go to a lender, and the first thing that lender is going to do is they're going to pull your credit report. And within your credit report is a credit score. And there are 5 factors that actually affect your credit score, and we'll be talking about each one of them today. But this is going to determine what your rate of interest is going to be. And there are different scoring systems, and there are different, of course, credit reporting agencies, and they have their own scoring systems, but 90% of lenders use what is called the FICO Score, and that was created by the Fair Isaacs Company. It was two men that were mathematicians who had went to college together, and they came up with this scoring system that helped lenders and businesses determine whether or not they would be able to grant you services or loans. So we're going to talk more in general about the FICO score. And then also too, one of the things that you can do, I had talked earlier about credit reports, and you are you can get a free copy of your credit reports from the 3 credit reporting agencies within 12 months. So with your free credit reports, they don't cost you any money. Of course, they're free. But with your credit score, because each of the credit reporting agencies has their own scoring system or their scoring model, it is not free. Your credit reports will belong to you. It's your information. Your credit score is your credit score, but because you didn't determine how it was scored, you're going to have to pay for it. And that is one of the places that you can go is myfico.com, and it can cost about $20 to get a copy of your credit score. One of the things that we like to let consumers know is when you get your credit score and you have to pay for it, be careful with myfico.com as well as other credit reporting agencies and other services, because what they want to do is give you, of course, your credit score for an amount of money, but they also want to sell you services that can help you monitor your credit score. And that would be a monthly charge. And because your credit score is going to change constantly, it's never really going to be the same. Sometimes it's like the stock market. It can go up and down depending on the different categories that affect your credit score. So it's going to change constantly. And we don't necessarily recommend that you have somebody monitor your credit score and then send it to you every month, because more than likely you're not going to need to know what your credit score is every month. So let's look at what actually makes up your credit score. And like I had said earlier, there's 5 factors. Some weigh a little bit more and some are less, but the number 1 factor in your credit score is your payment history, and it's worth 35%. Paying your bills on time and in full is the best thing that you can ever do for your credit score. And your payment history over the last 2 years carries a higher weight than maybe if you were late 3 years ago, 4 years ago, or 5 years ago. So one of the most important things that you can do is to make sure in a 2-year period of time that you don't have any late payments, that you pay everything on time, because it does carry a higher weight. And then amounts owed. And sometimes you're going to hear this term called utilization. It is worth 30% of your credit score. Not quite as high as your payment history, but it does carry a higher weight than some of the others. And what this basically means, it's the amount or the with total balance that you have on a credit card versus what your limit is. And to give you an example, let's say you have a credit card that has a $1,000 limit. And right now your balance on your credit card is $500. Your utilization ratio is going to be 50%. We recommend that you keep this ratio under 25%, because anything over 25% can pull your credit score down. And something else that we recommend is if you're using credit cards, they're great tools. They're great to have, but make sure that if you are using credit cards, pay them off if you possibly can at the end of the month. So never charge more than what you can pay, and just make sure you keep that utilization ratio under 25%. And then your credit history. This is the length of time that you've used credit, and it's worth 15%. The longer you have had credit, the better that looks to a lender, because you showed a lender that you're able to handle it for a long period of time. And a lot of times I will work with younger people who are kind of just starting off in life and starting to get credit and use it, and they may get a car loan and say, oh, I paid on it for 3 months. I'm going to have a high credit score. Well, of course, we said payment history is very important, so if you paid it on time for 3 months, that's a great habit to get into, but 3 months really isn't going to build you a long credit history. So the longer that you've had credit, the better it can make your score. And then inquiries, that's worth 10%. And I'll explain this a little bit more in detail because there's really two types of inquiries that can happen on your credit report. The first kind of inquiry is what we call a hard inquiry or a hard hit. This is when you are actually going to a lender or you're asking a business for services. You are initiating this request, and that can affect your credit score. It's anywhere from 2 to 25 points that it can make a difference in your score. Now, there's also something that's called a soft inquiry or a soft hit. It doesn't affect your credit score because you're not actually asking for credit. It could be that you have applied for a job and the employer has pulled your credit report to look over your information. You're not requesting credit, so it's not going to affect your credit score. It could be that maybe you got a pre-approval credit card in the mail. Of course, we said earlier that lenders can buy credit reports from credit reporting agencies, so they are actually soliciting you. You're not asking them for this credit card. Now, if you choose to take it, it would then become a hard hit because they would pull your credit again and so forth. But however, you're not going to be charged for that inquiry. And also, too, a lot of times people will start car shopping or start shopping for a home, or you go to a mortgage lender, and of course, you want to find the best rate, and sometimes you have to shop around, and most lenders are going to pull your credit to see what your credit score is to determine what your interest rate is going to be. One thing to keep in mind is if you're out car shopping or if you're out mortgage shopping and you do these things in a 30-day time frame, you're only charged for one inquiry per category. So if you're out car shopping and you've went to maybe 5 different dealers and 10 different institutions have pulled your credit in a 30-day time frame, that's one inquiry. And the same thing with mortgage lenders. If you've went to several different mortgage lenders, they've pulled your credit in a 30-day time frame, that's one inquiry. So that ends up being 2 if you're looking for a car and a mortgage at the same time. But as long as it's within a 30-day time frame, it's only one inquiry. And then the last factor that's going to affect your credit score is the credit mix. What type of loans do you have? And it's worth 10%. And in a credit mix, a lender wants to see that you are able to handle different types of credit. So if you have a car loan, if you have vehicle loan, or I'm sorry, a mortgage loan or a credit card, then this is a good mix, and this is more favorable in the lender's eyes because you're able to handle different types of loans than just maybe one credit card. And I love this slide here because it tells you the difference between having a great credit score and having a bad credit score, and how it can really affect you when you are when you get a car loan or a mortgage loan or whatever. So earlier I had said that we're going to talk about the FICO score. In a FICO score, you can have a score anywhere from 300 to 850. That's the range. And of course, you want a high credit score. A lower one is not favorable to you. So the higher the score, the better it is for you. And in this particular slide, it's giving you information about the average 60-month fixed rate auto loan for $18,000 in the state of Virginia as of September of 2014. So some of this could have changed a little bit, but probably not a lot. So let's look at the person who has done everything right with their credit and they have a 720 to 850 score. That's a great score to have. Their interest rate's 2.75 and their monthly payment is about $321. Over the life of this 5-year loan, they're going to pay about $1,300 in finance charges or in interest. But let's go to the bottom of the page and let's look at the person who has a low credit score, a 500 to a 589. The interest rate has tripled and it's at 10.75. Your monthly payment is going to be about $390, and over the life of this loan you're going to pay about $5,000, almost $5,400 in interest versus the $1,200. Now, one thing I know a lot of times when I talk to people in financial counseling, they are able to pay that $70 difference in their monthly payment. Oh, that's okay, you know, I can still pay, you know, $70 difference. But they don't always look at how much money they're spending in the interest over the life of the loan. And you see that that's a huge difference. That's about a $4,000 difference. That's what it's going to cost you in 5 years when you maybe don't have a favorable credit score versus if you did. And then also, too, people with lower credit scores are really good targets for predatory lending, because they can offer a rate of anywhere from like 18 to 33%. And let's say that you wanted to take out a loan and maybe your monthly payment would be about $350 a month. You could only take out $12,000 loan. And in the end, you're going to pay over $9,000 in interest for that loan. So again, you know, this is just a great example of how a low credit score can work against you and how a high credit score can work for you. I also have a handout that I will be sending everyone who's participating in the webinar. It gives even some more scenarios of somebody who has a high credit score versus someone who has a lower credit score, and I think it'll be worth your while to kind of read it and see the examples that's given to even give you better understanding. So what are some of the impacts of a poor credit score? Well, housing choices. If you're out maybe looking to rent an apartment or a townhouse, the landlord will pull your credit, and if you have a low credit score, it could make a difference in what you're going to pay in your monthly rent. It could also prevent you from even being able to lease something. Ability to obtain utilities. A lot of the utility companies will pull your credit, and if you have a low credit score, they may require you to have a cosigner, or they may require a huge deposit for you to even have utilities. That way, they have that deposit on hold in the event that you don't pay your monthly payments, and then they have that money to fall back on to recoup some of those costs. It could be the difference of whether or not you can even get a loan, and if you have a car that maybe is no longer reliable to you and you need to get a new vehicle loan, it could make a huge difference in you even being able to get a loan. Cell phone choices. I don't know if all consumers know this. I know some people do that I talk to, but not everybody does. Cell phone providers will pull your credit report, and they do look at your credit score. And the reason that cell phone companies do this is because when you purchase the phone from them and you sign like a 2-year contract with them, most of the time you're not paying that retail price for that phone. And let's just say, for example, the iPhone 6. When they came out, I believe they cost anywhere from $500 to $600, and some providers were offering them for a very low discounted price, but you had to sign a contract. And that cell phone provider knows when they look at that low credit score, you haven't taken care of your debt obligations on time. You may not pay your cell phone bill on time. So they're going to charge you maybe some type of a deposit, and they have that money again to recoup that cost and that phone that they gave you at a discount price. And then car insurance rates. When you need to purchase car insurance, the car insurance companies will pull your credit because there have been lengthy studies, even though I have some people say, you know, that's just not fair. Just because I have a low credit score doesn't mean I'm going to go out and wreck my car. But there are studies, and one was from the Conning and Company, that shows people who have a lower credit score have filed 40% more claims than someone who has a higher credit score. So someone with a lower credit score may pay anywhere from 20 to 50% more in premiums than if you had a higher credit score. So having that low credit score can really impact some of the choices, just everyday things that we use. It can really affect them. And not only can a credit score or a low credit score cost you thousands of dollars, it can also affect whether or not that you get a job. And according to this survey in 2010, and I apologize, I don't have anything for you that's more recent. I looked and looked and I couldn't find anything that was more recent, but in 2003, 35% of employers checked credit reports. And then, of course, you see that number almost doubled in 2010. Just 7 years later, 60% of employers checked credit reports. And a couple of reasons why, and we think about jobs at financial institutions, maybe even government jobs, there's a higher risk of embezzlement. And there are studies, again, that do show people who have a lower credit score, they can not manage their finances, or maybe they're just more of a risky person. So what do employers look at when they pull these credit reports, and what matters most to them? And the top two are judgments and collections. And just to let you know what a judgment is, just in case you don't, a judgment is when you have had either a service or maybe you've had a loan with a financial institution and you decide not to pay it. They can take you to court and sue you. And of course then you owe them the money. And then collections. A collection is when it's turned over to a collection agency, and then that collection agency tries to recoup the money that you owe to that particular business. And the reason why these are the top two, and there's a couple of different reasons. Number one, an employer, when they're looking for an employee, of course they want someone that can, you know, do their job and do it successfully. And it may be because you've had a judgment, you may have to go to court, so you're taking time off from work, it's pulling you away from doing your job. And then the same thing with collections. A lot of times collection agencies, they're not available after you get home from work, so you may be needing to call them and talk to them during work hours, and again, it can draw you away from your work. So employers know this. And another thing that they know is you've not managed your debt obligations well. So if you haven't managed those well, are you going to be able to manage your job well too? So just remember that employers do check your credit report, and not all employers do, because we know it's 60%, but of course we see those numbers rising over just a 7-year period. And I would like to see maybe a recent survey to find out if that's increased even more. And then how to build a strong credit score, because, you know, sometimes things happen and we can make bad choices. And that doesn't mean if you have a low credit score that you're never going to be able to have a high credit score. You can. And it's just going to take time. It's not going to happen overnight. But it will take time, but eventually you will get there. So I do want to encourage you to know that it is definitely a possibility, but it is going to take some work on your behalf. And of course, start, if you're not doing this already, pay all your bills on time. And maybe you're somebody who forgets to pay them. Set up bill payer to help you. That way the payments go out when they're supposed to and you don't have to worry about it. Also watch your utilization ratio, and again we said to keep that below 25% as possible at all times, and more likely at 0. So make sure you keep that ratio under that limit, and then don't close all old accounts. Remember we said payment history has a factor of 15% in your credit score. You want to keep that payment history. You want to show lenders that you are paying over a longer period of time. So don't close all your accounts. If you have a bunch of credit cards open and you just don't use them and you just don't want them out there, look at the newer accounts before you look at the older accounts. And then, of course, we talked about inquiries, wanting credit, asking for credit. Don't go out and open a flurry of new accounts because that can affect your credit score. It can bring that down. Very quickly, if you're out there applying for every credit card that you're offered and wanting to get a new car, looking at mortgage lenders, I mean, just kind of spread it out over a longer period of time. Don't open a bunch all at one time. And then be a cautious cosigner. If someone is asking you to cosign on a loan for them, there's a reason why. And you want to make sure that if you do choose to be a cosigner, that you are informed on the loan activity at all times, because a lot of times the cosigner is not even informed until the loan goes late, and then of course it's been reported on your credit report, and now you have a late payment showing out there, and that can of course affect your credit score. 35% is what the that it affects on your credit score, is paying your bills on time. And then read new banking and credit card disclosures. Just know when you do take out a new credit card or any kind of service, know what the disclosures say. Could they increase your interest rate if you're late one time? That can happen, so make sure you read the disclosures, because you don't want to have something that all of a sudden your payment jumps up $100 a month and you're not able to pay it. And then something else too, and I didn't realize this and I had never thought about it, but pay your library fines. They can turn them in to a creditor, and when something's turned in, it doesn't matter the amount, it's just there on your credit report that you have now a collection. So be sure you pay those on time. If you go to the library and you check things out, just ask them. Make sure you don't have anything that is still out there and maybe you forgot about or whatever. If you have children, make sure they turn their whatever they've taken from the library on time, and make sure they have no fines as well. And then improve your credit score. Look for and correct errors. Earlier I had talked about how you can get a free credit report from each of the 3 credit reporting agencies in a 12-month period. What I would recommend is, if you are trying to improve your credit score, if this is just something you're determined to do, I would recommend that you go ahead, instead of spreading it out over the course of the year, go ahead and get all 3, because something could be on one of the credit bureaus information that may not be on another one. So make sure you get them all at the same time, look over them, and if there are errors, dispute it with the credit reporting agency. And then contact your lenders. If you're behind, a lender wants to work with you. They want to help you out, because a lender is at loss if someone doesn't pay on time or just doesn't pay at all. A lender's at loss just like you would be. So it's a win-win situation. There are certain instances where you can negotiate your interest rate or even get your payment reduced. So reach out to your lenders. Don't be afraid to do that, and they're definitely there to help you. And then pay all your bills on time. And when I say that, everything. Some things are not reported to a credit reporting agency, but this gets you into a good habit. If you pay your utilities and you pay your cell phone bill on time, the things that may not necessarily show up on your credit report, you're in a good habit of doing that. So if you're going to pay these things on time, you're going to pay your debt obligations on time. So just get into a really good habit of doing that. And then pay down your debt. We talked, several times about your utilization ratio. Just look at that, try to get that paid. If you're way over that ratio, it shows that you're going to become overextended. So that might be the first place that you want to start, is to look at some type of a debt payment program. If that's something that you may be interested in doing and maybe you just don't know where to start, at the end we're going to have a slide and it has my information on it. Contact me, because I have a program that I can lead you to that will show you how to make some type of a debt payment program that would fit what you needed, and it would help you to start paying that debt down. And then apply for a secured credit card. What basically that means is you're going to use cash as collateral, and that money is put into account somewhere, and then you are given a credit card where you can use it. You pay it off at the end of the month, you're building your credit, and you pay it on time, so it's reporting in your favor. But then that money that you've used for collateral is there in the event that you don't pay it. So it's secured, unlike most of your credit cards are unsecured. And I won't talk to you all day about the last one, although I could, because I think this is so important for people. If they don't have this, it can get you in trouble. But establish emergency funds. And what I mean by this is have an account somewhere that's set up in the event that an emergency happens. Something breaks that you weren't aware of. One of the things I like to ask people is, if your refrigerator broke today, or if your car broke down today and it needed the motor replaced in it, would you have the money to pay for that? And most people will say, no, I don't. And the next step is they go to the credit cards and they use a credit card to pay. And of course, that's what credit cards are for, but most of the time then you don't have the money at the end of the month to pay that credit card off, and now your utilization ratio is higher than it should be. So get into a habit of putting money into an emergency fund, and we recommend that you have 3 to 6 months of budgeted expenses saved. Now I know that kind of makes a lot of you kind of think, I can't do that. Well, you're not going to do it overnight, but you can do it over a period of time. So, start off at having 1 month, having 2 months, having 3 months saved, and then eventually you will get there. And that is all the information that I have for you today, and I want to thank you again for joining us. We'll wait for just a few minutes and see if we have any questions, and while we're waiting on questions to come in, I do want to let you know in August we will be doing the third in the series on credit topics, and it's going to be how to protect your credit score. And this will be talking about identity theft and fraud and different things like that. So, once you kind of make it to that place and you've got that credit score the way you want it, your credit report is clean, it looks good, you don't want anything to come along and make what you've worked so hard for, make something bad happen to it. So we definitely want to teach you in that webinar how to protect your credit score. And it doesn't look like we have any questions, but I want to thank you again for joining us, and I hope you have a nice rest of your evening. Thank you, and goodbye, everyone.